So I'm gonna start the recording and then I'll edit like the junk from the beginning. And now I'm gonna make you the host. That way.
Awesome.
Perfect. It's all on you. So I don't know if you're familiar. Realtors run in their own time frame. They're usually 5 minutes late, maybe 10. So I'm gonna mute myself, put my video down, and then I'll come back to check on you at 11 and 11:05, and we'll go from there.
Sounds good. I'll get everything set up so we'll have the presentation up on the screen. And I'm used to it working with business owners. They all run on their own time as well. So yeah. It's not a problem.
Yeah, so that's a common thing here. They always run in their own time. But gotcha. We're excited to have you. And yeah, we'll see. I'll see you in 5 minutes when I come back to check on you.
Sounds good. Thanks. Alrighty. Yeah, this is.
Morning, everyone. It's 11 a.m. We are waiting for the realtor time to come into 11:05. So we let you guys join. I know some of you have doing a big effort to be here today. So thank you so much for showing up. We have Scott. He's the nice background. He's going to be our speaker, and he has all the little details that we need to know about this tax savings for realtors. So we're going to give it 4 more minutes. It's 11:01. And we'll be joining right after that. So if anyone have any questions in the meantime, feel free to unmute yourself, put on your camera. We have like pretty much like 5 free minutes of discussion before we start.
Maho?
Yes?
Will this session be recorded? Because Yasmin's asking if this will be recorded. So, because she's in a meeting right now, she wants to hear.
Yes, so I asked Scott already, we're gonna be recording this meeting and we're gonna be posting it on our internal group and on our YouTube channel that you guys can rewatch. And if you are not from the Realty One office and you wanna give me your email so I can make sure to send you a link with the recording. So please put down your email if you're not part of this office. Thank you.
Perfect, thank you.
Alrighty, so it's officially 11:05. Thank you so much for those who joined. Once again, my name is Majo. I'm the marketing manager at Realty One Group Future in San Ramon, California. If you are joining us from a different company, welcome. We do these little webinars every so often to keep you guys updated with all the good things that are happening around us. And then today we have Scott. Scott is going to be talking about tax savings strategies for realtors. It's a long name, but that is what it is. And then he's going to be able to pretty much tell you more about all of these little details. And then if you are not part of our company and you want to drop your email on the chat, you can send it directly to me. I'll make sure you get a recording out of this after the meeting is over. So thank you so much for joining, and I think we're ready. So Scott, the floor is yours. I'm going to be monitoring the chat. So if anyone has questions, please drop it off in the chat.
Great, Majo, thank you very much. Thanks for having me. I appreciate being here. I appreciate everybody taking their time today out of their busy day for half hour, 45 minutes or so. So as Majo said, my name is Scott Levin. I'm a senior partner with a financial planning firm called Worthington Financial Partners. We specialize in working with small business owners and entrepreneurs in all different types of planning, both individual and corporate planning as well. So today, what we're going to spend a little bit of time on is just talking about the basics with regards to qualified plans and essentially some of the options that are available to you with regards to saving taxes off of your income that you're earning as a realtor. There are still opportunities out there for doing 2020 tax planning, even though we are now in the second quarter of 21. I'll talk about that a little bit as well, but so there are certainly still opportunities if you're looking for tax deductions for 2020. Some of this stuff will be very relevant and very pertinent to you, or it is certainly stuff that you can look at for 21. So, as Majo said, please, if anybody has any questions throughout, feel free to put those in the chat. Happy to answer any questions as we go along. And I'll make sure that Majo has all my contact information afterwards, that if anybody has any specific questions they don't want to address in a group setting, I'm happy to have a conversation or chat by email, whatever the case may be afterwards. Hopefully things will move quickly because internet sometimes can be a little spotty these days. All right. So very briefly, whenever we're talking about retirement, it's important to point out that realistically, there's over 30 million small business owners. And yes, every single one of you guys that are realtors are considered small business owners. Whether you believe it or not, you're running your own small business, and that affords you all kinds of opportunities to really take advantage of. So we're going to talk a little bit about that, but understand that you're in that category. Most small businesses, though, do not have retirement plans. Most small businesses, as you can see from this slide, have very few employees. So even if it is just yourself, you still have a lot of the same opportunities as a business that has 5 employees, 20 employees, or even 100 employees for that matter. And in some cases, you have even better opportunities if you don't have any employees. That being said, if you do happen to have some employees working for you, whether you have staff, an assistant, or 2, whatever the case may be, a lot of these plans may still be very relevant, and there is some planning opportunities that we can take advantage of that would still provide you a nice benefit, as well as providing some benefit to that employee as well. But a survey that was really done by the Small Business Council back in September of 2019 basically found out that one of the largest or major concern for most small business owners out there is planning for retirement. So hopefully we'll address that a little bit today and show you some options that are out there that maybe you should be looking into. So typically when we're talking about retirement, especially with regards to business owners, the first thing that typically comes to mind are what's referred to as qualified plans. And I'll get into that in a second as far as the different types of qualified plans. But the benefits of a qualified plan first and foremost is it's tax deductible to the business. Okay, so the income that you have coming in, whether it's coming to you personally as a sole proprietorship or it's coming into your S corporation maybe that or LLC that you set up, any contribution that you make to a retirement plan is fully tax deductible. Okay, so you're getting a benefit of a tax deduction. You're paying less to Uncle Sam in that regard. From a business perspective, if you have employees, you certainly can reward obviously not only yourself, but potentially key employees as well. If there's somebody vital to your business, to your practice that you would like to make sure that they stick around, well, setting up a retirement plan may be a great way to ensure that they do stick around by giving some an incentive to do that. And of course, if you just have other, maybe just an assistant that works for you from time to time, if you want, you can even provide them a benefit that may be meaningful to them and still help you keep that person around and provide a little something. I shouldn't say all qualified. Most qualified plans allow us the ability to purchase life insurance in there if that is something that is needed. One of the benefits is buying life insurance with pre-tax dollars. Another benefit that a lot of people don't really realize is it gives us the ability to complete or maybe even go beyond the completion of a retirement plan. God forbid that business owner doesn't make it to retirement, their family can be taken care of. Their spouse and or kids can potentially get the benefit that they were hoping for to fund over the next 20, 30 years. And that can be all done in one fell swoop. And of course, providing protection for the family should anything happen. From an individual standpoint, you're getting retirement benefits out of this. You're saving money on a tax deferred basis for benefit in the future. When it comes time that you're not working anymore, you're not generating income, but you've accumulated this pot of money that you'll use to live on. Because while Social Security likely will be there for everybody, it may not be there in the present form that it is currently in. And quite frankly, it may not be enough for most people to really live on, especially compared to the income maybe that you're used to, that you're living on right now. So here is a way to make sure that you can have the lifestyle that you want at retirement and control your own destiny in doing so, while still getting nice tax deductions and minimizing what you're paying to the government at this point in time. So as I said, the main benefits of a qualified retirement plan are the business gets a tax deduction. There's no current tax liability to you as an individual, whether you're the business owner or an employee in the plan. And the growth inside that retirement plan grows on a tax deferred basis. Now, that obviously means that when you go to pull the money out, you will have to pay taxes at that point in time, but we're exchanging a known tax deduction right now based on the current rates. And if anybody's paying attention to the news and everything that's being talked about, it's highly likely that tax rates aren't going down, they're going up. For a good majority of us, taxes are going to be going up, and they could be going up substantially. So if we're in a higher tax bracket right now, if we're in a rising interest rate environment, qualified plans can be a great tool to try to lower that tax liability and maybe minimize what we're paying to the government in exchange that hopefully at retirement 10, 20, 30 years from now, maybe we'll be in a lower tax bracket, or we'll at least have the ability to control our tax bracket in that we'll pull out only what we need to live on at that time. I like to use the analogy, I've never worked with a business owner that has voluntarily not gotten paid from a client, where they've gone to the client and said, you know what, don't pay me right now because it's going to put me in a new tax bracket. Can we defer the payment for 3 months or 6 months? Never had a business owner go that route. So we're always trying to make as much money as we can, and we'll figure out a way to minimize that tax liability. Versus at retirement, if you need $150,000 to live on, let's say, you're not going to pull out $250,000 or $300,000 from your retirement plan, pay taxes unnecessarily, and park the rest in the savings account. You're only going to pull out what you need at that point in time. So to a certain extent, you can control your tax bracket at retirement, where it's very hard to do that during your earning years. So who can have a qualified plan? pretty much any business or any entity that's out there, whether you're an S corporation, whether you're a C corporation, whether you're an LLC, whether you're a partnership, whether you're a sole proprietorship, filing a Schedule C, any of those entities can have a qualified plan, and obviously the benefits that we just talked about with regards to having a qualified plan. So there are two general categories of qualified plans that we're going to touch on a little bit today. The first category is what's referred to as defined contribution plans. The other is what are called defined benefit plans. In a defined contribution plan, we are saying how much, or the government dictates how much we can put away in that plan each and every year, and whatever it grows to at retirement, that's what it grows to. Versus a defined benefit plan, we're saying how much we want at retirement up to limits that the government establishes, which tend to be very high. And then through a series of calculations, we come back through today to determine just how much we can put away, or we're allowed to put away, in order to accumulate enough money to provide that benefit at retirement. Somebody's got their line unmuted.
I have a class today at 7.
Somebody have a question?
No, I think their mic is off. I don't have the host anymore, so you will have to do it. Okay, I think they block it.
I think we're good.
Yeah.
All right. So this is always the $1,000 question, $100,000 question, whatever you want to call it. How much can you contribute to a qualified plan? Well, it really depends on the type of qualified plan that we're talking about. So on the defined contribution side, we have 401k plans, which allow you to put away up to $19,500 through a salary deferral, if you will. If somebody is 50 or older, they can do what's called a catch-up contribution and put away another $6,500 on top of that. In a profit sharing plan or a SEP IRA, for instance, you can put away up to $58,000 if it is just you don't have any employees. However, you are limited to no more than 25% of your income or your W-2 income, depending on what kind of business entity you are. With regards to a defined benefit plan, there actually is no dollar limitation as to what your contribution is. It's based on a whole host of factors we'll get into. So defined benefit contributions can have contributions annually, $50, $100, $300, $500,000 or more, depending on what your income is, depending on how old you are, depending on how many years you have until retirement, and some other factors as well. So while defined contribution plans limit how much you can put away, generally no more than about $58,000, defined benefit plans have no annual limit with regards to your contribution. What's also nice about on the defined benefit side is if you're in business for yourself, you don't have any employees, depending on what your corporate structure is, if you're an S corporation, you're taking W-2 income, what you can put away in your profit sharing plan, you're going to be limited to 25% of whatever your W-2 is. So if you take a W-2 of $100,000, but you made $400,000 of income, in a profit sharing plan, you're going to be limited to 25% of that $100,000 or a $25,000 contribution, which you can see is far less than the maximum $58,000 you can do. In a defined benefit plan, you wouldn't be limited to 25% of $100,000. You may be able to get, depending on how old you are, how many years until retirement and other factors, you may be able to get a retirement contribution of $100,000 or more, even though your W-2 income was only $100,000. So a lot of potential options that are out there with regards to the plans. But it's important to understand with all qualified plans, there are applicable guidelines that we have to follow in order to get that favorable tax treatment. The name qualified plans really comes from the government in that they are qualified by the IRS. They have basically signed off on these plans, and as a result of following all of these applicable guidelines and rules, the government allows you to take a tax deduction for making a contribution to that particular plan, and you do not get taxed on the growth inside that plan while the plan is established, and you only have to pay income taxes on the back end when you start to pull money out to live on as earned income. All right, so we're going to start looking at what are called defined contribution plans. So typically the clients that are looking at defined contribution plans are typically younger owners, relatively new in the business, seeking tax deductions, but they're looking for a lot more flexibility in their contribution. Looking, if they have employees, looking to kind of attract and retain some employees, but want some control as far as that goes, but don't necessarily want high dollar commitments with regard to the plan, or they're not looking to put away a whole lot of money beyond what the limits are for a defined contribution plan. So how does it work? As a business owner, you establish the plan, okay? As I said, you're gonna be limited to 25% of whatever your W-2 income is. If you're an S or a C corporation, no more than $58,000. If you're a sole proprietorship, then it's going to be 25% of whatever your line 31 is on your Schedule C return that you file to the government. Once you establish the plan, we establish the platform with regards to investing the money. Typically is going to consist of stocks, bonds, mutual funds, whatever the case may be. If you have employees, we can certainly establish what's called a vesting schedule that allows you to at least retain a little bit of control of that money should that employee leave, kind of the incentive or the carrot, if you will, for them to stick around going forward, so that you're not giving a contribution to an employee that they're going to walk away with right away. Generally speaking, there are 4 different types of profit sharing plans. If you're only, if it's just you with regards to business, then the type of profit sharing plan we look at is what's called proportionate to pay. It's just a traditional profit sharing plan where it's a straight percentage of whatever your earned income or W-2 income is. If you have employees, then we can look at other designs such as being integrated with Social Security, an age-weighted plan that just weights the contribution more heavily to the older employees in the business. If that's you, great. If it's not you, then typically what we look at is what's referred to as a cross-tested plan. We call it a profit sharing select. And the bottom line is that we're allowed to put the employees into different groups and give those different groups different contribution percentages. The typical goal is we're trying to maximize the contribution to the business owner and minimize the contribution to that rank and file or those rank and file employees. Sometimes having employees can be a good thing, especially in a profit sharing plan, because you're not limited individually to 25% of pay unless it is just you in the plan. If we have employees as well, then we get to add up all of the payroll, yours and the employee's payroll, and then the company can spend up to 25% of whatever that total covered payroll is. So it may be possible for you to get a higher percentage of your income, getting closer or maybe trying to hit that $58,000 maximum if that's the goal, while not having to give a whole lot of dollars to those employees. So the other type of defined contribution plan is what's called a 401k plan. Most people are familiar with a 401k plan. It's important to understand that it is a payroll deferral plan. So it's driven by yourself and or employees by deferring from your income, okay? The employer, as a company, you can make a matching contribution. You can have a non-elective. There's a number of other ways that we can design a 401k plan, but it is driven by payroll deduction, if you will. Those deferrals can either be pre-tax or they can be Roth, meaning after-tax contributions. A lot of times with small business owners, we'll add a 401k plan if it's, again, just the business owner. It's what's called a solo K because we don't have employees to worry about, solely for the purpose of having the Roth feature, because they may not be able to do a Roth IRA on their own because they make too much money, first of all. Second of all, in a Roth IRA contribution, you're limited to $6,000, $7,000 if you happen to be over 50. In a Roth 401k, you can put away $19,500 into a Roth 401k. And if you're over 50, you can do an additional $6,500 on top of it. So if somebody's not looking for the upfront tax deduction, but wants the tax deferred growth and then tax-free income on the back end, whenever they want it, once they get to retirement, then doing something like a solo K or a 401k with the Roth feature is the best way to do that, because the contribution limits are so much higher. It is important to understand, though, that with a 401k or with a solo K, what's called a TPA is required. It stands for third party administrator. So we hire an organization that will actually administer the plan for you. They'll provide the plan documents. They'll take care of all the administration. They'll help you with all of the filing. They'll prepare all of the filings that go to the IRS to let the IRS know that you have this retirement plan and you are getting these tax benefits with regards to your company and or yourself personally. And of course, with any type of qualified plan that we're looking at here, there are going to be annual administrative fees that go directly to that TPA for them doing the work. So how does it work? Well, you create the 401k plan, okay? Either you and or any employees that you may have make deferrals into the plan. As a company, you can decide to do a match. You can decide to do what's called a non-elective contribution, just giving everybody a percentage of their salary across the board, whether they decide to defer or not, and or even make a profit sharing contribution. Much like the regular profit sharing plan, we're going to invest in stocks, bonds, mutual funds on an investment platform. And then anything that you and or an employee defers into the 401k portion, not the company contribution, but the employee deferral is always going to be 100% immediately vested, meaning that deferral really is coming out of your payroll or it's coming out of that employee's payroll, that their salary, if you have an employee that wants to participate as well. So what are the limits with regards to defined contribution plan? I touched upon it a little bit already. For a 401k plan, the most that you can contribute for this year, for 2021, is $19,500. These limits do go up, not necessarily every year. It's actually now, this is the second year in a row. The maximum contribution has been the same. Hopefully, fingers crossed, next year for 22, that $19,500 will go to $20,000. The catch-up contribution for a 401k is $6,500. So between the two, if somebody is 50 years old or older, and you just have to be turning 50 by the end of the year, which is 12/31, to be able to do that catch-up contribution, somebody could defer into their 401k plan up to $26,000, okay? SARSEPs don't really exist anymore. If you already have it, you know it. If you don't know what that is, it doesn't matter because you can't set it up. The other alternative on that defined contribution side is a simple IRA that sometimes people hear about. Sometimes it's a good alternative. However, as you can see here, the limits are much less. The most you can defer in a simple IRA is $13,500, and the maximum catch-up is only $3,000 as far as that goes. The other thing is simple IRAs aren't able to exist with any other plan. So where the 401k plan can exist with that profit sharing as well, and even defined benefit plans that we're going to look at, simple IRAs can only be a simple IRA, nothing else. Questions so far? Anything out there? All right, so next we're going to talk a little bit about defined benefit plans. So defined benefit plans really take the opposite approach almost from defined contribution plans, in that we're looking at what kind of benefit can we have at retirement, typically retirement being as early as age 62, and then through a series of calculations come back to today to figure out how much can I put away this year and subsequent years to accumulate this benefit that I can then have at retirement. So typically, defined benefit plans are going to be for older employees or for older business owners rather. I say typically with regards to this, that's not always the case. This year, actually, well, really for 2020, I've set up about 3 or 4 defined benefit plans where the business owner is in their mid to upper 30s. Okay, so typically defined benefit plans are going to be for older business owners, but that's not necessarily always the case. We like to see few to no employees. That's the ideal scenario for a defined benefit plan, where it's only the business owner, or they may only have one or two rank and file employees that are much younger than them. They're not making a whole lot. Those are typically good candidates for a defined benefit plan, usually within 5 to 10 years of retirement. But again, that's not always the case. As I said, we've done a number of plans for clients in their mid to late 30s, where it's still, they can put away a lot more money in their defined benefit plan than they'd be able to in their profit sharing plan. In those cases, about 2.5 times what they could do in a profit sharing plan is what they're able to do in the defined benefit plan. But you do want to have a business that essentially has been around for a little bit and that has got good consistent income. There is some flexibility in some of the defined benefit designs, but you don't have the same type of flexibility that you have in a profit sharing plan. In a profit sharing plan, you can decide after the end of the year, I don't feel like making a contribution for last year, and you're okay. With regards to a defined benefit plan, it's a little bit more of a fixed commitment, though you can have a range of contribution that you can fund to give you a little bit more flexibility with regards to that funding. And typically for a defined benefit plan, the budget is more than 25% of your income, or what's called total covered payroll, where somebody's looking to put away more money than what we can do in a profit sharing plan, either by a percentage standpoint or by a dollar amount, in order to try to max out what they're really doing. So speaking of maximums in that regard, the maximum compensation and hence the maximum benefit that we can provide in a defined benefit plan at retirement, at age 62 retirement, is $230,000 of benefit, or what's called the lump sum equivalent of that number. So we can fund for $230,000 of income at retirement, or the lump sum equivalent, which depending on the design can be anywhere from about $2.5–3 million to over $4 million of retirement assets at retirement. However, in order to get a benefit of $230,000, somebody's average what's called 3-year average compensation must be at least $230,000. In other words, you can't be showing just $100,000 of income and fund for a benefit of $230,000 of income at retirement. So you've got to be showing that income in order to fund for that benefit at retirement. Now, the beauty of defined benefit plans is that line there where it's a high 3 consecutive year average. Once that average is established as a business owner, it doesn't matter what your income is going forward from a salary standpoint. So if you're an S corporation and you've maxed out your compensation for 3 years in a row, maximum compensation, you can see at the bottom of the slide, is $290,000 for 21. For 2020, it was actually $285,000. So if you've already got 3 years where you've got maximum compensation, you don't have to keep taking that large of a W-2 salary if you don't want to, in order to still get the same kind of contribution in your defined benefit plan. Because it's based on a 3-year average, after that average is established, the income that you're drawing as a business owner becomes irrelevant. So that's where you start to pick up some flexibility, where you can say, I only want to take $100,000 of salary this year. I only want to take $50,000 of salary this year. You don't have to keep taking the maximum qualified plan salary unless you're trying to max out your benefit each and every year. Then you potentially may want to do that. That's very different from a profit sharing plan, in that if you had a $200,000 salary in a profit sharing plan, and you were able to get a $50,000 contribution, let's say, and the following year you, for whatever reason, messed up and only took $100,000 of salary, well, your profit sharing plan contribution is going to be limited to 25% of now $100,000 or only $25,000. You wouldn't have that issue necessarily in the defined benefit plan. Defined benefit plans, as I said before, also have no specific contribution limit. So the government does not limit how much your contribution can be each and every year. It's all based on providing this benefit, whatever it may be, at retirement. So there can be plenty of circumstances where your contribution to the defined benefit plan actually exceeds what you're showing as W-2 income. Now, if you're a sole proprietor, where you don't have a formal entity set up, it's important to understand that the maximum defined benefit contribution can't exceed what your total income was from your sole proprietorships. In other words, you can't create a loss in your sole proprietorship because of a retirement contribution. However, if you're an S corporation, you can create a loss in your S corporation by making a retirement contribution that is greater than, let's say, what your net income was in the business. And that loss that you create in your S corporation would then flow through to you personally, which could reduce your taxable income even further. Just a planning technique that we sometimes see there. So what's involved with regards to determining plan contributions in a defined benefit plan? Well, first is retirement age. As I said, age 62 is the earliest that the IRS really likes to see where we can fund for full retirement benefits, that full $230,000, assuming somebody has that much of income to use for funding purposes. So between 62 and 65, we're allowed to fund for full retirement. That being said, you don't have to retire at 65. We've got plenty of clients. I've got clients in their mid to late 70s and even early 80s that still have defined benefit plans in place and are still making contributions to their defined benefit plans because they're still working, they're still earning income, and they're still getting tax deductions that they desperately need, even if once they're over age 72, they have to take money on the back end because of what are called required minimum distributions by the IRS. So retirement age is a factor. Duration, meaning how long we have to fund the plan, how many years you have until retirement, which also has to do with age of entry, how old somebody is coming into the defined benefit plan. Average compensation plays a very big role. Sometimes it may be the last 3 years. If somebody just started their business, then it's going to be what their last year was. That's their average. Year one income is their average. Year two is going to be the average of year one plus year two divided by 2, and then same thing for year 3. Once that 3-year average is established that somebody is comfortable with, we don't necessarily need to increase income, meaning W-2 income, in order to still maintain the level of contribution that we want. And the type of products that are used to fund a defined benefit plan also come into play. Certain products, certain funding techniques will allow us to put away more money up front in a defined benefit plan when a business more likely has it. That then will allow us to put away less money as we get closer to retirement, as we're kind of winding the business down and maybe not making as much. So there's generally 2 categories of defined benefit plans. There are actuarially funded defined benefit plans, and there's what's called a 412(e)(3) fully insured defined benefit plan. The actuarially funded defined benefit plans are literally the original pension plans that the government created back in the 1930s. These are the types of plans that all of the large corporations that are still in existence from that time frame, such as IBM, Procter & Gamble, AT&T, General Motors, all of these companies and more had these defined benefit plans. But back when they were created, they were able to set up these defined benefit plans only for, let's say, their upper level management, CEO, CFO, the management group that oversaw the company. They didn't have to include all of their tens of thousands or hundreds of thousands of rank and file employees. That all changed in the 70s, and a lot of those large companies, most of those large companies, got rid of their defined benefit plans, but it didn't get rid of defined benefit plans in general. In fact, at that point in time, that's when it became much more meaningful and much more obvious for small businesses to take advantage of these types of plans, because they started to realize they could put away potentially a lot of money in a short period of time, get very large tax deductions, so that they can minimize their taxable income during their earning years, and then control the distribution on the back end when it's coming out. So generally speaking, a traditional or actuarially funded defined benefit plan versus a 412(e)(3) are very, very similar. They're essentially working for the same goal. There are little nuances, differences with regards to those goals at retirement, but generally speaking, we're working for the same dollar amount at retirement. It's how we get there that's really different. There are differences. Every business, every individual really is different. We'll run proposals for businesses all the time. It's all based on that business's census, name, date of birth, annual income, date of hire, all is relevant with regards to running numbers. So there can be variations, but generally speaking, a 412(e)(3) defined benefit plan will produce a higher deductible contribution than a traditional defined benefit plan. Both of them have benefit guarantees, meaning what somebody is going to get at retirement essentially is going to be guaranteed. From an administrative standpoint, a 412(e)(3) typically is, not typically, it is less expensive to administer administratively, because a traditional defined benefit plan requires an actuary. Actuaries have a good bit of schooling. So as a result, when an actuary comes out of college with all of their degrees, they are typically commanding six-figure incomes, which basically goes into the cost of administering traditional defined benefit plans. Doesn't mean that they're bad. The traditional plans are bad, and they're not substantially higher than 412(e)(3s, but they are typically a few $100s or so more expensive to administer than a 412(e)(3). The contribution level, typically what happens in a 412(e)(3) is you start with the highest possible contribution that you can get from any type of defined benefit plan. And over time, that contribution actually steps down a little bit in the early years and much more in the later years. The reason being, and the reason a 412(e)(3) is called a fully insured plan, has to do with the products that are used to fund that fully insured plan. Those products have ironclad contractual interest rates guarantees. So those guaranteed interest rates are what the administrator uses to calculate the contribution. Generally speaking, we're looking at guaranteed interest rates of about 3%, give or take, okay? Versus a traditional defined benefit plan, an actuarially funded plan, uses an interest rate or range of interest rates really that is established by the IRS each and every year. Generally speaking, that range right now is in about the 5 to 6% range. So as you can imagine, if we're looking at a higher interest rate from a calculation standpoint to figure out our contribution, the higher the interest rate we're theoretically going to earn on our investments, the lower that contribution is going to be. So our 412(e)(3) typically produces a higher contribution initially because we've got a lower interest rate assumption. In a traditional plan, we're dealing with a range of contribution every year. That actuary, based on the interest assumptions that the IRS establishes, produces a minimum contribution, a maximum contribution, and they'll have a recommended. That recommended may be smack dab in the middle. It may be closer to the maximum, maybe closer to the minimum. Just depends on the year, depends on previous funding, depends on performance of the investments in the defined benefit plan. But as a business owner, you can fund anywhere between that minimum and maximum contribution. And there are times where that minimum contribution may be zero, and that maximum contribution may far exceed what that 412(e)(3) contribution is in a given year. It doesn't usually start off that way, but it can get that way over time unless we control it by changing the benefit formula. So there is some flexibility in the traditional versus the 412(e)(3. That contribution is calculated every year, and what it is what you're required to fund. You do have the ability to transition the 412(e)(3) to a traditional defined benefit plan at any point in time, which will cut your contributions down substantially and give you that flexibility later on. So we like to throw something in with regards to life insurance in qualified plans. It's not an area that that most people typically think of as far as utilizing, but it is something that can be great from a planning tool. There has been a lot of talk over the past few years, especially over the last year, from very prominent money managers looking at life insurance as an asset class from an asset allocation standpoint. But not all retirement plans allow you to have life insurance in the plan. So your IRA plans, your simple IRAs, your SEP IRAs, you are not allowed to have life insurance in the plan. But with regards to defined contributions and defined benefits, you are, though there may be rules with regards to specific product type and or there are maximums that you are able to have. And that's one of the telltale signs. I like to talk to clients. Anytime the government puts a maximum on what you are able to do, you know it's actually a very good thing. Otherwise, they wouldn't put limitations or restrictions on it. So the government does limit how much life insurance you can buy inside, or how much premium essentially you can have inside either qualified retirement plan, because they don't want you having too much of a good thing, essentially. So some of the benefits of actually using life insurance in a retirement plan, whether it's a defined contribution or a defined benefit plan, is those premiums are now being paid with pre-tax dollars. So there are a lot of people, not enough, unfortunately, but a lot of people have personal life insurance, hopefully, to protect their family. God forbid something happens to them, to provide, income, to replace their income, to cover a mortgage, other debts, whatever the case may be. Most people, though, are buying their life insurance with after-tax dollars. If your premium is $1,000 or if your premium is $10,000, you've probably got to earn $1,500, $1,600 or $15,000, $16,000, pay the income taxes in order to net the dollars that you need to pay for that life insurance premium. Well, that same, for instance, $10,000 life insurance premium inside a retirement plan may actually only cost you about $6,000, because you may be getting approximately a $4,000 tax deduction if you're in a 40% tax bracket for making the contribution into your retirement plan and using some of that contribution to buy the insurance on a pre-tax basis. So that can free up after-tax dollars, to be used personally other ways. Even though you are buying the insurance with pre-tax dollars, your death benefit is paid out to your beneficiaries completely income tax-free. So as I said, it is a way to fully fund your retirement from day one, even if something happens to you and you didn't get a chance to fund your retirement for 10, 15, 20 year time period. You could fully fund your retirement and make sure your spouse and or kids are certainly taken care of. The cash value that is used inside that is accumulated inside the retirement plan, that is used for for retirement purposes. So it's not as if this is wasted dollars, if you will. You're using permanent contracts that are building up cash value as well as having the death benefit. And that cash value is part of the retirement benefit that you're going to get out of it. It is part of the assets of your retirement plan and has value associated with it. And of course, as we talked about before, business receives a tax deduction in general with regards to making any contribution to a retirement plan. So everybody is obviously aware of the main purpose of life insurance, and that is to protect somebody, in case they die, okay? Provides a benefit, a death benefit to beneficiaries if that insured passes away. What a lot of people don't realize, though, is that there are some contracts out there, not all, it's important to understand that, but there are some contracts out there that have what are called accelerated benefit riders, okay, ABRs. These are riders that can provide tax-free benefits if you have a terminal illness, if you have a chronic illness, if you have a critical illness or a critical injury, you can potentially access some or all of your death benefit completely income tax-free while you are alive to be used any way you want. It does not have to be used for medical purposes, though it certainly can be. Maybe, God forbid, something happens and you have a critical illness that requires some sort of experimental therapy that has proven successful, but the insurance companies aren't going to cover it. You can certainly try to pay for it out of pocket, or if you have a life insurance policy that has an AVR rider that provides this critical illness benefit, for instance, you may be able to access some or all of your death benefit to get the funds completely income tax free to pay for that experimental therapy that you may not be able to come up with the money or have to liquidate assets or sell assets in order to do. So it can be very beneficial by providing what are called living benefits. It's insurance that essentially you don't need to just die for in order for somebody to receive a benefit. So a very important added benefit of having life insurance inside retirement plans as well. And then, of course, a lot of times we'll get the question, well, if I have life insurance in my plan, what happens when I retire? What happens when I shut the plan down and I'm all done? Well, there are many options that are available. Here are a few as far as what to do with the policy. And it really comes down to planning that we talk to clients about as well with regards to the back end. So we're involved with regards to the front end, designing the plan, helping to administer it by working closely with the TPA. We're there every step of the way with regards to managing the plan on an annual basis. But we'll also have discussions as we're getting closer to that magical retirement age, what are we going to do with everything? What are we going to do with the assets that we've accumulated? What are we going to do if we have life insurance in the plan? How are we going to get it out, or what's the best option? And there are several options that are really available depending on what your situation is at that time. So almost done, actually. So there's always, when we're dealing with the government, and like I said, qualified plans that have these specific rules and regulations that we have to follow, there are always dates and deadlines with regards to implementing different types of plans. So for deferral plans, we're talking about a safe harbor 401k plan, which would be relevant if you have any rank and file employees, or a simple IRA. That plan needs to be established by October 1st of a particular year in order to be able to make a contribution for that particular year. With regards to a solo 401k or a just traditional 401k, December 31st is the deadline to have the plan established in order to be able to defer from your payroll. The one exception to that would be if you are a sole proprietorship, where you really aren't taking W-2 income. You're not a corporation. You're an individual entity, if you will. Sole proprietorships can actually establish even solo 401k plans up until their tax filing deadline. Technically, what has to happen is by December 31st, though there's no carbon dating to verify this, but technically by December 31st, you're supposed to have a written note in your file of what your intended deferral is going to be for that particular tax year. But nobody follows behind you to check to make sure that actually happened. If we're talking about employer-funded plans, profit-sharing plans, defined benefit plans, and even SEP IRAs for that matter, then you actually have until the corporate tax filing deadline, including extension, to establish and fund those types of plans. It's important to know that the government, in a rare instance, actually gave us a gift that effectively became implemented this year in 2021 for the 2020 tax year. I hinted at this a little while ago, and that is you still have the ability to set up profit sharing plans and defined benefit plans, of course, SEP IRAs as well, but profit sharing and defined benefit plans now in 2021 and get a tax benefit for the 2020 tax year if you haven't filed your taxes yet. And I'm actually in the middle of doing about a half a dozen profit sharing and defined benefit plans right now that we actually have just started in 21 for the purpose of getting tax deductions for the 2020 tax year, because now businesses are finally getting with their CPAs. They're finally getting a handle on what their taxable situation was for 2020. And they're saying, oh my gosh, I'm going to owe how much in taxes? What can I do about that? And, you know, that's when I get the phone calls and say, I need to set up a retirement plan. What are my options? How much can I put away? This is what my taxable income was for the 2020 tax year. So understand there are still plenty of planning opportunities available. The tax extension deadline can run either up until September 15th or October 15th. We generally need about 30 to 45 days in order to properly establish the plan, and it just needs to be set up and funded by the time you file your taxes, including those extension deadlines. So plenty of time left from a planning perspective, in case anybody happens to still be interested. And that's pretty much all that I had for today. I'm happy to stick around in case anybody happens to have any questions.
Scott, thanks for doing this for us. I apologize. I wasn't on the initial call, but we jumped in here. So a lot to cover. Our agents, I'm sure, are appreciative of that. We've got a great turnout. So a lot of details, maybe some head scratching at least, but Scott's very well versed in this. Thank you to Grace and Yasmin for getting this on and bringing it to our attention as well. And Maho for coordinating this. Maho, when you take off your video, my picture shows up as your name. So, I mean, I was getting confused if we're looking like twins still.
I don't know. In my account, it says like it's me, but then it shows us up you. So I guess
I guess working together that much, we can get confused. But anyone, please don't hesitate. You guys, I know this is something that a lot of you have inquired about and wanting to find out. So this is a great resource here on what should we do, how should we do it, how to mitigate, how to plan properly. And so Scott's open to any questions here right now. If not, then we will convene some other time here and work it out and get your contact info to these folks. So anyone want to venture and talk about anything? I know it's sometimes a little bit more personal, but it should be okay if it's a general question in terms of what you're thinking or what's the best way to approach it. I think, Scott, that's really what is the first step, I guess, for a lot of people get a little bit caught up in the analysis and it basically paralyzes them because they're not sure, are they, or even should they have a base amount of money or what to end up doing this? Are they making enough money to do this? And that's sometimes a question in itself.
Sure. So that's a great question. So what I would tell everybody is pretty much anybody is a candidate for a qualified plan. Just what type of qualified plan, we'll figure that out as I go through this with each person individually, ask some questions, get a census as far as what their specific business really looks like, what kind of income they're making. We can talk about what kind of expenses that they have. You know, while we talk about, and I kind of hinted upon it, that defined benefit plans in general are typically, and a lot of what you hear in, I'll say the industry in general, is that, oh, defined benefit plans, you can put away a whole lot of money, 6 figures or more. And that is true. But I will tell you that I have a number of clients where their defined benefit contributions are only $20,000, $30,000, $40,000 a year. And the reason being, they're not drawing much in W-2 salary. Okay, they don't want to draw much in W-2 salary. And if you're only taking, let's say, $50,000 of W-2 salary, whether it's a SEP IRA or it's a profit sharing plan, you're limited to 25% of that W-2 salary. Okay, so you're not putting away a whole lot of money, versus if you're doing a defined benefit plan, you may be able to put away substantially more than just 25% of your W-2 salary. And that's what they may be looking for. They want to put away $20,000, $30,000, $40,000. They don't want to take a large W-2 salary, and the only way to get there is to do a defined benefit plan, for instance. So the purpose of today was just to let people know that there are a lot of options that are out there. I wouldn't expect anybody to know exactly what option is going to be best for them, or to come to me and say, I want X type of plan. My goal for today was really just to expose you guys to stuff that we talk to realtors and other, I'll say, niche industries as well. I have a lot of doctors, I have a lot of dentists, I have a lot of small business owners that all fall under the same types of categories as you guys, where they're looking for more advanced planning. They're looking for something to be a little bit more creative, something that can be tailored specifically to them based on their needs, their circumstances, their situation, what their cash flow is like, what they're comfortable putting away on an annual basis. All of that becomes relevant with regards to the discussions. We'll talk about all that, and we'll always be able to look at some numbers and figure out what the different designs really look like, and figure out what makes the most sense for that individual versus somebody else. You can have two people that look the same on paper, and you can have two vastly different plans because of what's really underneath or what's behind the scenes that you don't see just on a written piece of paper.
I'm glad you mentioned that, because there's a lot of parallels, right? But there's goals are different, destinations are different. So I love that commonality, but at the same time, it's tailored fit to what the individual goals are. And those are things that you're going to extract that aren't on paper. So I appreciate that. Thank you for.
Yeah, sure. Look, I mean, I know for a fact, because I have some realtor clients that are like this, that they do real estate because they love it, they enjoy it, not because they have to, not because they need the money, they're not the primary breadwinner. Okay, they make a decent living doing real estate, but they're not living off of their income. They have a spouse, let's say, that does well, that this is to keep them busy, to keep them occupied. They love doing it, but they're paying taxes on this income that they would love to be able to reduce. Well, that's fine. Let's set up a plan. You can continue to work, you can continue to enjoy what you're doing, and let's shelter the money from the IRS for a while, so that you're not giving it all back to Uncle Sam unnecessarily.
Excellent point. Excellent point. So as daunting as it sounds or can be, make the first step. Scott, again, thank you for
my pleasure
being here. We appreciate it. What's the best way? Are we going to put your contact info here just to make sure everyone's got it and we don't lose it lost in translation here? So let's make sure that we do it. Mao, can you put in the chat, or Scott, can you guys put it in the chat here as well?
Yep, I can. Let me stop that. Let me see how I can. I will copy. Let me copy my contact information and get it out there.
Please do that. And then, guys, if anyone for some reason they're driving or they're unable to grab it, just we'll send it out as well. But that way we can cover it while we're on.
When I send the video recording, I'll attach the information for everyone.
Okay.
So it's Scott's info, and then I'll attach the video, and then so you guys can like rewatch it and then talk to him if you have more questions.
That's a great thing. I did get a couple texts that is this being recorded?
Yes.
So glad to have that done. So I will. For those that are still on here, if not, then I'll respond to this text and say, oh, yes, it is being recorded. There we go.
All right. So I just sent out all my contact information from my email signature, and I can forward that to Maho as well. So she has it. I'll include my brochures, my PDF brochures, which feel free to share as well. Gives a little background on me and talks a little bit about the planning process that I developed. That I work with small business owners with. So happy to help anybody, happy to answer any questions, that anybody may have going forward.
Fantastic. Thanks again. Everyone enjoy their day, the rest of it. Talk to you soon. And we truly appreciate it again. Thank you so much.
My pleasure. Thank you. Thanks for having me.
All right. Bye-bye.
Perfect.